Welcome. This is Stacy Francis, President and CEO of Francis Financial. And today we're going to be talking about Trump, the markets, and your portfolio. Now what? There's a lot going on in the world today, and we know that it might cause you concern, anxiety, and for some people even fear. Fear about what's going to happen to the market, what's going to happen to their nest egg, their investments. What is not only the short term, but what is the long term now that we have Donald Trump as our 45th president? All eyes are on the stock market, and news about his election drove the market into a downward spiral. In futures, the stock market was down nearly 5% as individuals had that knee-jerk reaction of selling stocks in the short run. What's interesting, though, what we saw is that after the shock settled in, the market rallied on Wednesday. After that chaotic night, this surprise victory for Donald Trump set in, and individuals started to think about what his policies mean and how that impact will be on the stock market. They've quickly come to realize that the implications for financial assets, investments, are not as dire as many might have feared. That there are numerous very pro-business policies that he has that will very much impact and help the market move forward. One example are drug stocks. Democratic presidential candidate Hillary Clinton had outlined plans to curb drug price increases. However, Donald Trump does not have that type of regulation on his agenda at this point. Therefore, we saw drug stocks skyrocketing with the hope that, again, they will not be regulated in the same way under a Trump administration as they were projected to be regulated under the Clinton administration. The other area that did phenomenally well is financial services. They are looking at repealing potentially protections that the Obama administration put in place to protect consumers, allowing financial firms such as Goldman Sachs and some of those others to shed some of these protectionistic laws. While those laws, in my opinion, are needed and they're good for me and they're good for you in protection, they cost a lot to those companies. It allows these firms to make a lot more money, similar to they did before the banking crisis that we saw in 2008. Because of that, yesterday you saw banking stocks through the roof. The market ended up closing yesterday nearly 1% up. Does that mean that we've crossed the concern, we've crossed and overcome the risk? The answer to that is something that we're going to talk about today. Talk about what volatility we expect going forward, what you can do to protect your nest egg, and also to secure your financial future. So with that, let's get started. As we all know, in shocking events, Donald Trump was elected president. This was what is considered a surprise victory, as the weeks coming into these final days showed Hillary Clinton in the lead. Shortly after, we saw markets, particularly closing in Asia, with huge losses. As I mentioned, in futures, the S&P 500 was down nearly 5%, and those countries whose markets closed during the chaotic evening of that election night also showed significant losses. Here, the Nikkei index, you can see down more than a 5% loss. The Hang Seng lost almost 2% at that market close. In Europe, we saw that around 11:30 yesterday, started to be able to digest that information, as I mentioned before, realizing that there are some upsides to his policies, however you believe, pro or con about them personally. So the FTSE 100 was up, as well as our German and French stock market also ending up. Finally, we have the S&P 500 ended up closing really nicely, closed up. And then we have the one area that is still continuing to be negative, not surprising, the Mexican stock market closing down. Number one, because of concerns about potentially restricted trade with them, as Donald Trump has mentioned as one of his policy agendas going forward, and also that wall that he says he's going to build. So those were things, of course, that are concerning to the Mexican stock market, and in turn, we saw it ending at a loss. But again, what I think is really positive as we see is that the market, other than that first knee-jerk reaction of losses of 5%, was able to digest the news and be able to act what we think is in a more appropriate way. We look at this very much like the Brexit vote, very much so. In fact, that dramatic reversal in odds for Trump is really reminiscent of what we saw with the Brexit vote for Britain leaving the European Union. That, too, followed with a massive sell-off. In fact, with European stocks that we see here shaded in gray, we saw losses of over 13% in only a few days. What happened long term? Well, interestingly enough, in the few months posting that time period, we saw a complete recovery. In fact, European stocks, you can see here, were up 14%. In fact, they continue to trade at their pre-Brexit levels. In fact, higher levels than they were before that major announcement of Britain leaving the European Union. So there's been a lot of shocks to the system that we have seen over the last couple days, and also true, definitely, over the last couple months. But what I think is important to take away this lesson is that the market will continue to go forward. And one of the worst mistakes you can ever make is believing that this time is going to be different, that this time, whatever shock it happens to be, is going to be the essentially tipping point that turns the market down into a deep depression that we cannot recover from. That's just not the case. But what I can guarantee that there's going to be a lot more volatility. There's a lot more volatility because Donald Trump essentially is more uncertain. Whatever you believe politically, Hillary Clinton, her win was priced into the market. That's what the stock market expected. And in fact, the stock market was favoring Hillary because they could very much more understand her stance, her policies, and really a continuation of the same type of focus that the Obama administration had previously. Well, if anything, the market hates change, the market hates uncertainty, and Trump really represents uncertainty. That's why we saw that initial nosedive in the market during those chaotic hours in the morning on early Wednesday morning before the election was actually called. It represents a lot of questions. There are still questions. Trump's agenda lacks detail in the way that we've seen other presidential candidates put forth. He also departs from the typical Republican Party tradition, thoughts on trade, on security, on entitlements. And he's even been at odds with many very high-profile leaders within his own party and has advisors really advising and directing him that are much less known. And therefore, again, represents uncertainty to the market. And that's part of the reason why we saw that deep drop in the market value before the opening hours. That, too, is part of the reason that we're going to continue to see that volatility, that up and that down, as we start to get to know Donald Trump better as the 45th president of the United States and become familiar and schooled and educated about what policies are truly going to be his main drivers. And secondly, even with the House and the Senate being Republican, how many of those policies is he going to be able to put forth to make the changes he's looking for? Now, what about the long term? The short term, no question, a lot of volatility. But what about the long term? Are we heading for a down market, potentially a recession? Even some analysts have said the word depression. So let's take a look. We're going to look at election years and get a better idea of what types of returns occurred the day after they were elected. What's interesting as you look at this, you can see that a very large number of candidates actually had negative returns after Election Day. And as we go on to see, it has absolutely no bearing on the performance of the stock market going forward. So that's something to know that's very positive. So that initial 5% loss that we saw really doesn't necessarily have a bearing on what the rest of his presidential candidacy is going to look like. But how are things going to look like even from now till the end of the year, now until Inauguration Day? We put together this chart to show you just that. And I think it really, if anything, should give you a little peace of mind. Going through all of these different historical past presidents, you can see that from Election Day to Inauguration Day, almost all presidents enjoyed some very hefty stock market positive returns. Herbert Hoover had a 13% return before he was then inaugurated March 3rd, 1929. We also see a Barack Obama when he was elected as of January 21st, 2013, elected for his second administration, enjoyed a really nice 4% return. You can see all these different presidencies. So again, post-election, we typically start to see some positive movements in the market upwards. As far as those presidencies that did not perform well, there actually are a few. In fact, this is showing you that election year, what the market was, and then the year subsequent, so the year after. So this is talking about what can you expect in the rest of 2016 and what can you expect in 2017. Well, what's interesting as you look at all of these different presidential teams going forward all the way back to 1928. You see both Republican, you see Democrat, but I think the biggest trend is that you see that the majority of them are over here on the right-hand quadrant of this graph. And the positive news of that is that it is showing you that the vast majority, the year of the election and that year right after, had a positive stock market. Now, I know what you're doing. I know what you're seeing. You're seeing two very, very large negative returns. The first is with Obama and McCain, and that is definitely something to take note of. But if you look more clearly, you see that it's pegged to a very significant economic event, and that is the Great Recession. There, too, you see another with Roosevelt in 1939. 1939, you know the 30s, what happened? back to our history books, we know that that was the Great Depression. So the piece that we want to take from this is that it's not necessarily if our administration is Republican or Democrat. It's not necessarily if it's an individual and their personality versus another individual and their personality. The stock market has survived very strange election cycles as well as very harrowing periods in our country's history. But you can see that the stock market returns are not driven by who necessarily is in office. It's much more driven by the economic events occurring during that time. So let's take a look at this piece. This is the chart that gives me the most comfort out of anyone. This looks at the returns during the presidential term, that 4-year term for a president. And we can see here that almost every single presidential term over that 4-year period actually had positive returns for the S&P 500. Again, there were three that had some significant losses. Not surprising, they are those same exact economic events that impacted the returns that we saw in the previous chart, and that is the Great Recession as well as the Great Depression. Right there. So let's take a look at going forward, and this is a really interesting chart. It goes all the way back to 1926. Assuming you had $1 and you invested $1 in the market, what we've done is we've included the returns of the S&P 500 and the returns on that $1 invested going forward to essentially today. We've also shown you the individuals that were the different administrations, both Republican, Democrat, Republican, Democrat, Republican, Democrat, and so forth. What we can see is that across all of these administrations, the S&P continues to march forward. Again, not surprising. Right there, the Great Depression, and then the Great Recession were really the only significant drops that we saw. Again, very much focused on the economics of what's going on in the economy. So what does this mean for you? What does this mean for your outlook? Well, there are 5 things that you can do, that you have control over to help your portfolio. Because let's be honest, you don't have control over the returns in the stock market. That is something that you are not able to influence really in any way. But the things you do have control over is, number 1, letting the markets work for you. Because as we just saw with Republican administrations, Democratic administrations, we see that the S&P 500 over time continues to march upwards. You want to be a part of that. The second thing that's really important is being as tax efficient in your investing as possible. That means being smart where you put inefficient investments such as bonds, trying to put them into your retirement so they're essentially protected from taxes, tax deferred. You want to take more efficient capital gain assets such as your stocks and have them in your non-retirement accounts. These all add returns of anywhere from 1% to 3% each year just by being smart of where you place your assets in either taxable accounts or tax-deferred accounts. And number 3, of course, learning to invest in the most efficient, lowest cost way possible. Why would you pay $10 for a radio and be able to get it somewhere else for $50 for the exact same product? You would, of course, pay that $10. That's what we believe too. And savvy shoppers are not only those in the stores. You need to be a savvy shopper with your investments too. Number 4, diversify. We've all heard, don't put all your eggs in one basket. And that is true for your investment portfolio as well. You need a very well-diversified portfolio with a mixture of different types of bonds, international stocks, emerging market stocks, as well as U.S. stocks. Diversification is key, and it is the largest predictor of what your investment returns are going to be over time. And the final piece, the 5th piece, which I think is the most important, is staying disciplined. Discipline means staying with that ideal investment allocation in good times and bad times. It's those that do that that are the true winners over time with their investment returns. In fact, let me show you this. This is a great chart to actually show you that information. Those people who are disciplined, those that stayed in the S&P 500 index, stayed in there from 1970 all the way through 2015, did not try to time the market, and kept their money working for them in that part of their portfolio, $1,000 invested would have grown to $89,678. That is more than a 10% return. Now, what about those individuals that were trying to time the market, trying to use a crystal ball maybe, or just hoping for good luck of coming in and out of the market when they thought the market was either going to drop or increase? Well, if we go down to assuming that maybe they missed 25 of those best single days over the last 45 years, their return on that $1,000 would have only been $21,000, a 6.87% return. Now, what about those individuals that say, I don't even want to be in the market. I want to be in the most conservative investment there is. And so they instead put their money in ultra-conservative 1-month U.S. Treasury bills. They, in doing what they thought was safe, turn out to really miss the boat. Instead of $89,000, we're looking at a mere $9,000 in total after 45 years of their money being invested. What they think is safe is not necessarily the safe thing to do. Missing only a few days of strong returns, as we can see, can drastically impact and reduce your overall performance. So you just don't want to do it. You want to stay disciplined. You want to stay invested. And I know that it is a very tumultuous time. I myself have felt a lot of stress, I'll be honest. So much so that when I went home at night, last night, I was so tired that I was actually nauseous and could not eat. Well, I have to tell you something that gives me peace of mind, and hopefully you too, is that this time is no different. Just as we said back with the 9/11 terrorist attacks, this time is different. The market isn't going to recover. With the subprime mortgage crisis, again, many people said this time is different. Market is not going to be able to recover. Our fiscal cliff worries, again, this is different. This is different. The market is not going to recover. Well, you can see is that the market did recover. It did recover, and it continued to march on. And going forward, we are, of course, going to have additional shocks, some things that we don't even see on the horizon that have such unexpected consequences. But know that long-term investing is exactly just that. We don't look at the long term. We look out at the horizon. And it's that horizon that you shoot for. You can see in this chart that had you stay invested, that $1 that you invested back in 1970, over these years, across all of these very frightening and tumultuous shocks, would still be $45. So again, it's knowing that there will be shocks, but that you have a portfolio that is constructed exactly for that, to cushion the blows, but have the growth to propel you forward. I know that this is a tough slide to look at. There's a lot of detail. But I will tell you the most important piece of it is that those people who actually have the courage to invest money when the market is volatile, particularly after the market has fallen, win big. In fact, I'm going to just show you this. I don't know if you remember the European debt crisis, where the S&P 500 had downgraded the U.S. government debt significantly. It was the first time in history this had ever happened. We saw a massive loss in the S&P 500 that day, and I remember that. I was on a plane, and I had live streaming TV. It was JetBlue, but can I tell you, the feeling of absolute dread of watching the S&P 500 just tank went down to 6.66% that day. It was a massive, massive loss. Those people that looked at that as an opportunity, those long-term investors that invested at that time in a one-year time period, enjoyed a 28% return on that money. Over 3 years since that time, had a 22% return each year. Those investors for 5 years plus enjoyed a return of 17% each year. So as unintuitive as it may seem, investing when things look like they're going horribly wrong, or when there's a lot of high levels of fear, buying stocks when fear runs high has historically led to long-term gains. And that's what our investment philosophy is all about. It's about your financial security. It's about long-term growth to get you to your goals, those goals of retirement. Maybe it's that vacation home, sending your kids to the college that they've always dreamed of. But the path can be bumpy. And that's what our goal is to help you understand what your level of risk tolerance is, to minimize the ups and downs, minimize the tax impact, to make your portfolio as efficient as possible. Having a disciplined, evidence-based focus, thinking clearly, and not letting emotions get in the way of sound investment decisions. That's what we're all about. Helping you achieve your goals. I know that this is definitely a very volatile time. And it is not only in politics, but it's definitely in the stock market and bond market too. So I ask you, please reach out. If you are not currently a client, we are happy to also give you a second opinion just to see where you're at. If you are a client, you know that our door is open to you anytime you need more information, questions answered, or just a friendly voice to talk to. I can't thank you enough for investing in yourself to learn more about your money. We all need to know more about our money, because it's with that knowledge that you can make really smart financial decisions. And it's smart financial decisions, one after another, that lead to long-term financial security. That's what we all strive for. And I have to tell you, every single person deserves that. We deserve to be financially secure. You work too hard not to be. If you have any questions, please reach out to me. You can reach me at info@francisfinancial.com or my personal email, Stacy, STACY, @francisfinancial.com, or feel free to give me a call. I love to chat on the phone. 212-374-9008. Thank you for your time, and have a great day.